Good morning. Welcome back to the Broadcast Retirement Network. This is BRN Weekly for Saturday, July 20th, 2024. And our top story today, investors are still bullish on the stock market. Joining me now to help break it all down, Jane King joins us from the NASDAQ. Jane, so great to see you. Thanks so much for joining us on the program this morning.
Thanks, Jeffrey. Great to be here, as always.
Yeah, it's your analysis is always spot on, in my opinion, and I think the audience opinions. We enjoy having you. Let's talk about this week, the week that was in the stock market. One survey I saw, and I think this was from Morgan Stanley, is that investors, and I guess that's institutional investors, retail investors, remain significantly bullish about the stock market. Get your thoughts on that.
Well, typically when we start to see that happen, the so-called smart money starts to get out. And we saw that actually start this week. They rotated out of the big tech companies, and the excuse was, well, President Biden had mentioned perhaps some punishment for US chip companies that were selling equipment in China, and then which would cut into their profits immediately. And then President Trump talked about to Taiwan paying for some or all of their defense. And so, those two things were like, whoa, Taiwan makes so many of the chips that, so many companies want, that there was concern about that. So we saw the chip sector sell off. In fact, it lost about 500 billion in market value on Wednesday. I'm trying to remember exactly which day. There's been a lot of news going on this week.
There has been a lot of
Yeah,
news.
there's
Yeah,
been a lot of
absolutely.
news, a lot of things to keep political and otherwise. So, and they went into some of the small cap companies, which have done nothing over the past couple of years. So it was nice to see them get a little bit of life. And some of the bigger, the Dow above 41,000 for the first time ever. So the money came out of the NASDAQ, went into the Dow, and they're just rotating. It's a big rotation.
Yeah. And Jane, we had, I think the joblessness claims, the weekly joblessness claims went up.
Yes.
So more than expected. Thoughts on that, and what does that mean to the Fed, which and to traders and to markets?
Well, it was, I believe it was 243,000. So that was the highest since early June. Now, the speculation was that because some of these may have been a holdover from July 4th week, that maybe people were like, oh, I'm traveling, I'm not going to file my unemployment claims this week. And so they waited till the next week to do it. That might have given it an artificial boost. So I think next week's employment claims are going to be really interesting to watch.
Yeah, and how about the Fed? I mean, I've been reading, I guess I'm not reading the tea leaves, but I'm reading actual comments, and it seems like a interest rate cut in September is becoming more and more plausible. At least that's what the market's think, and maybe it's backed up somewhat by Jerome Powell and some of the other Fed governors' comments.
Yeah, well, I think he said this week that maybe we won't stick to that 2% inflation rate before we cut. So because we're about what, 3.4% now. And so I think, the market is expecting an interest rate cut in September. Now, that could be priced into the market. We could be anticipating that over the past several months, and maybe this is a buy the rumor, sell the news kind of thing, like we see so much in the market. We'll also get another CPI report in August. So if that one also shows that inflation is cooling like it did last month, then I think that increases the odds of a cut in September.
And you talked about kind of trading the news, and a lot of news this week. We don't cover politics per se, but a lot. How does the political environment, does the political environment at all shape what the market is doing or considering? I think a lot of people know about futures, but does it shape the trades? Do traders really look far out to January and say, oh, this person's going to win, or this group's going to control the Congress, or this group's going to control the Senate?
Yeah.
Does that news really shape the long-term trajectory of the markets?
Well, there's a lot of moving parts with this. So there are individual stocks that no question have been impacted, like Trump Media and Tech and Entertainment, or Tech Media and Technology, I think is what it's called. DJT is the ticker symbol. That immediately got a boost after the failed assassination attempt on Saturday. So that stock, very volatile, but it seems to react positively by quite a bit. When it looks like there's more likelihood that Donald Trump will be reelected in November. Some particular sectors have, fossil fuels have done well this year. That's more friendly to a Trump presidency. Green energy, more friendly to a Biden. So you see it in some sectors. And then just overall, the thinking is that, a Trump presidency might lead to less regulation, but it could also mean more tariffs. So, and who will control Congress? So it's kind of, it gets very complicated when you try to kind of predict that. But, I think the markets are just more focused on what the Federal Reserve is going to do, and the political scene is kind of behind that.
Yeah, it's interesting. I mean, a lot of people, I think, in you watch the major media networks, they try to tie it all together. And I think people, look, I think markets are made up of people and entities, and they will all seek their own self-interest. And if they think it's going to be good for them, they'll be bullish
Yeah,
on it. If not, they'll be bearish on it. And I think I don't know. I'm not being dismissive of it, but
that's what
I think
makes the market.
I know, but you got to look at that. I think that's why you have to look at the long-term track record and actually the indices, pretty important. Jane, we're going to have to leave it there. Always great to see you. Thanks so much for joining us, and we look forward to having you back on the program again next week.
See you next time.
Thanks, Jane. Great to see you as always. Excellent analysis. And when we come back, we'll take a look at some of our best segments for the week. You're going to want to stay tuned right here on BRN Weekly. Now is your opportunity to co-create content around any topic on the First Lifestyle and Wellness Network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device. Welcome back. It was another great week of programs with great topics and, of course, great guests. We kicked off the week with a look at what medical ailments lead to the highest medical costs. Let's take a look.
It's been an interesting 25 years. That's how long I've been kind of in this space, helping to help employer groups, help our clients really understand what's happening when it comes to claims, why they're so expensive, why we see trends. So it's been a really great use of both my nursing background, and then also I also have an MBA, so a little bit of the business background as well. 12 years ago, we decided it was time for us to kind of help our clients by providing data on which claims were most costly, see whether or not we could see trends, and then hope that that information could be used by our clients, which are really employer groups, to help kind of navigate, where do I need to go? What do I need to do? How do I support my employees to first avoid risk, but even more importantly, to make sure that my employees are grabbing access to care. Became really easy in my 25 years ago when I started in this industry. It became really clear to me that the number one way to avoid risk when it came to healthcare was to provide the best quality care. I mean, if you have good quality care, if you're accessing care where you should, it's the most opportune for your employees, then you're actually going to mitigate risk. There might be some upfront cost, but in the end, quality care equals less risk. So if we go back to your questions about diseases, one of the things that our report has shown to us is that there are top 5 categories that really, are the most expensive for employer groups and for members, if you will. We always see cancers, both the blood and the solid organ cancers, as usually a 1 or 2, or maybe 1 in 3. This year it was 1 in 3. That's really very clear. You have cancer is being treated very well these days. There's a lot of innovation in that space. We've come a long way. We treat cancers now a little bit differently. They're almost as if they're chronic diseases once you get out of that acute phase. So you see care going on for longer periods of time. And so it's not shocking that that would be, a costly type item for an employer. Some of the other areas, cardiovascular, which you brought up, is another really interesting space that we're seeing an increase year over year in people, in that realm. You had mentioned obesity and health concerns. That is one way that employers and people can help mitigate those risks, right? Quality care in those areas. But I think another thing that's coming out of it could very well be that we're also seeing baby boomers staying and working way longer than they had in the past. And so are we seeing an aged population when it comes to employers? You know, they're keeping on people longer periods of time. We saw during the pandemic that individuals are now able to work from home. It kind of comes across as like, maybe I'll just work a couple more years, you know, why not, right? It's kind of easier than it had been in the past. And so there's a chance that we are seeing some of those numbers increasing because just the population has changed. We're seeing, you know, people of higher age, you know, in the workforce. There's also the pandemic itself, right? COVID does have or had some inklings of cardiovascular issues with it, more so than I think we originally thought. I think people saw it as a pulmonary disease. You know, you got the flu and you had your cold and you felt like, you know, this is the lung problem. And what it really is a cardiovascular issue. So there's some of that probably creeping into our numbers as well. But as you can see, when we talk about these things, it's the whole purpose, right? We need to take a look at what's happening and then analyze why it's happening, and then try to come up with ways to mitigate that risk or help our members get better care so we can kind of avoid that risk and optimize that treatment. I think what we are seeing and why, you know, the industry in which I work is self-funded, and self-funded employers are really kind of managing their own plans. What is it that my employee is going to get when it comes to care? What is it that they're going to get when it comes to benefits? And they want to have a little bit of control on that. And I think that's my number one recommendation, to be honest with you, is, you know, having your plan open to providing care that might come up that you're not really maybe normally would have seen or been prepared for. Having it being a little bit more loose to, you know, bringing in additional resources, vendors outside of the network itself to kind of help you in those key areas. And I think too, another thing that an employer group should do is really analyze their demographic. What is it that is happening? Like if that employer group has a particular demographic, say it's a school district, and they know that they have more of this than that, they have an age group that has children, they might have whatever it might be. I think that's another key area. And then you can target into the disease processes that align with those demographics. And I think that's another important thing. As consumers, I think you brought up some really great points. You should be looking at your benefits wholly. You should be talking to human resources about what is out there. You should see whether or not there might be affiliated apps that your organization uses to kind of steer you towards benefits that are good for you or capable for you. You know, whether or not, I don't want to name particular names, but you know, there's some out there that really are wellness promoting types of organizations and apps that are out there. Use them, look into them. Figure out whether or not there's something out there that you can do as a consumer of medicine that can help you manage your health overall, and then hopefully avoid some of those higher cost claims that we see.
Next up, we discussed how food brands are lowering their prices to bring back inflation-weary shoppers. Let's take a look.
Well, you know, as we looked at that CPI, Consumer Price Index for food, you know, it really leveled off. It's basically flat versus the month before. And so, but if we compared to a year ago, it's certainly higher than it was a year ago, but that month-to-month change has really flattened out to not much change at all. So that's really the good news, is that we're really starting to see the increases that we've seen have really begun to slow. The data, or the chart I like to use, is the drought monitor map. And you see that picked up a lot of places in popular news and whatnot. And if we looked at Texas, you would really see the state kind of split in half, an east and central, and then a west. And the west part continues to have a lot of drought, particularly the southwest part. The eastern half of the state, boy, we've had a lot of rain, and folks got even more from that storm Beryl last week. And so, you know, we got some haves and have-nots on the drought side of things. And certainly, you know, that does certainly affects cattle production, livestock production, because it starts with rainfall and grass. But certainly that western part continues to struggle with drought as well. You know, if we look at retail beef prices, you know, there's the CPI data reports two different beef prices. One is a sort of choice beef. And so choice is that USDA grade you may see on the beef that you buy at the store. That actually is actually below a year ago, just a little bit, and flat to a year ago. And so that's an area that we've actually seen falling prices. Now, we like to compare, us economists, we compare it oftentimes to a year ago. And I think that's an important point, because a lot of people look at that and say, well, that doesn't matter to me. What's it doing in the short term? Is it higher than it was last month? Well, a lot of these food items and a lot of items we buy have a significant amount of seasonality to them. We could think about beef is like grilling season. We hit the summer, everybody's buying hamburgers and hot dogs or steaks to throw on the grill. So there's this seasonality to not only demand, but supply. So when we compare to a year ago, we're really kind of factoring out that seasonality effect in a simple way. But, for me as a consumer, I'm interested in what it did versus, last month or over the last 2 weeks. And if we look at retail beef prices, they were pretty much flat, almost the same price as they were last month and a little bit less than a year ago. If we looked at the CPI data, we could break food into two parts. Food consumed away from home, which is really our restaurants and things like that, and food at home, which is our grocery store shopping. And those have been moving at very different rates. The food away from home, implying those restaurant prices, have really gone up much more so than food at home. And so now we see, a lot of our fast food places hit by this type of really rising prices, rising costs. And folks, the evidence is that folks are switching. They move to a little more food at home. And so they're trying to, how can I put a meal in front of people at a price point that they can afford or that they're willing to pay? So we are seeing those. I think one of the interesting things that we continue to see in the sort of the featuring the value meals. I saw an interesting one the other day that instead of a big hamburger, it was actually like the kids' meal size hamburger. And so the meal deal, the value meal was still there, fries, Coke, the hamburger, but it was the smaller burger. And so, but they're really struggling to get something that folks are willing to buy and afford to buy.
That wraps up this episode of BRN Weekly. Have a topic of interest, someone you think we should talk to? Drop us a line, and don't forget, for all the latest curated news and lifestyle, wellness, finance, tech, so much more all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content, and visit our website. Hey, we're back again tomorrow for another edition of BRN Sunday. We'll be joined by proven experts to help break down what's going on Capitol Hill in terms of retirement and legislation. And then we'll take a look at the stock market and the economy. Until then, I'm Jeff Snyder. Stay safe. Keep on saving. Don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.